You must have heard the phrase, don't put all your eggs in one basket. However, have you applied this phrase to your investment portfolio as well? In your investment portfolio, you should never be concentrated in just one asset class or even, in fact, just one mutual fund. You should try to diversify your portfolio by investing into different kinds of mutual funds. And so, for this, let us take a look at what are the different types of mutual funds that are available in the market. There are mainly three different types of mutual funds that are available in the market. These are equity mutual funds, debt mutual funds, and hybrid mutual funds. Let us first take a look at equity mutual funds. Like the name suggests, equity mutual funds generally invest all your investment amount into equity, which is the stock market. Now, since they are investing into the stock market, the risk associated with this kind of fund is also very high, and the volatility that is related to the stock market will also be seen in these funds. So these funds have a higher risk. But since stock markets have the highest potential to grow, these funds also have the highest potential to grow. So where there is more risk, there is a higher potential to generate higher returns. Now, equity mutual funds itself is divided into different subcategories. You have large cap funds, mid cap funds, small cap funds, flexi cap funds, and even thematic and sectoral funds. And you can choose to invest in any of these kinds of funds depending upon what your investment goals and your risk appetite are. The second type of mutual fund is called a debt fund. Now, in this kind of a fund, the fund managers invest into long-term and short-term debt securities such as certificates of deposits, corporate bonds, government bonds, treasury bills, and more. And this category is also subdivided into further subcategories. For example, you have liquid funds, you have short duration funds, you have long duration funds, and you have something called credit risk funds. And finally, the third main type of mutual fund is called a hybrid fund. Like you must have guessed by looking at the name, a hybrid fund invests both into equities and into debt securities. This means that by investing in a hybrid fund, you get the best of both worlds. And so, the hybrid fund may be less susceptible to market volatility and could generate higher returns due to the different asset classes that are present in the portfolio. Now, apart from these three main types of mutual funds, you also have some specialized kind of funds. Let us now take a look at these specialized funds one by one. The most popular kind of a specialized mutual fund is called an index fund. An index fund tracks an underlying index, such as the Nifty 50. And the index fund's fund manager invests your money directly into that index. So an index fund's portfolio is exactly the same as the index itself, in this example, the Nifty 50. So the allocation, the weightage to the stocks, and the kind of stocks are all replicated from that index. The second specialized type of fund is called a fund of fund. In this kind of a fund manager collects all the investments and pools them and invests them into a different mutual fund, which will probably be an international mutual fund as well. And so, the returns that you get in these kind of fund of funds are directly linked to the mutual fund in which the fund manager is investing. And now, the next kind of specialized fund is called an international fund. Here, as the name suggests, the fund manager takes all the investments and he invests into assets that are available outside your geography or internationally. So for example, you might be staying in India and an Indian fund manager might collect money from India and invests into other countries like US, UK or Japan. The fourth kind of a specialized fund is called an emerging market fund. In this kind of a fund, the fund manager invests the money into emerging economies such as India, Bangladesh, Brazil, Indonesia. In these emerging economies, the growth rate is far more higher. However, they do come with higher risks. So even if you want to invest in these kinds of funds, remember to keep your asset allocation tight and do not invest more than 40 or 50% of your entire investment capital. The next kind of specialized fund is called a real estate mutual fund. Now, this real estate mutual fund provides an alternative to investing directly into land or real estate or apartments. This gives you the opportunity to invest in a diversified portfolio of different real estate projects. And finally, the last kind of specialized fund that you can invest in is called a commodity-based mutual fund. Here as well, if you want to diversify your investment and invest into a different asset class such as commodities, you can use this kind of funds. Here, the fund manager invests your money into different commodities such as crude oil, natural gas, metals, and much more. And so, these are all the different kinds of mutual funds that are available for you to diversify your investment portfolio. However, please do remember, over-diversification may also become a risk. So allocate your investments properly. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.